Welcome back everyone, you're all here with Dividend Talks. Let's jump straight in. Today we are looking at MPW Medical Properties Trust, currently trading at $8.48. We're going to take a look at the graph. We're going to take a look at the dividend. Is the dividend safe? We're going to run it through our stock valuation system, see what our price would be after our margin of safety. And we're going to take a look at their financial statements very briefly. So let's start. So if we look at the 10-year graph, this is a stock that you do not wish you have been holding for the last 10 years, as this is down 46.12%. If we look at the year to date, this is also down 26%. One thing that investors will be curious to see is that the yield is 14%. Now, is this a value trap, or can we as investors take advantage of this company, and is it undervalued? So one thing I want to note before looking at the dividend safety is a red flag in my view. If we look at the long-term debt, we can see the last 5 years up here, it has been increasing and has over doubled from 2018, where the long-term debt was 4,037 million, and then the last report, December 22, 10.3. So that's one red flag. And if you combine that, if we scroll up here, you can see the cash and cash equivalents. It has been also declining from 820 million down to 230 million. So that's a red flag for me, one thing to consider, especially as we go into look at the dividend safety. Now the market cap is just under 5 billion and the price to FFO forward is 5.2. Now this doesn't really mean anything unless we go and dig in further. So Simply Safe Dividends have given it a safety of 40, which is unsafe. We're going to take a look at what this means and for our metrics. As dividend investors, we want shares, companies where the dividend will be growing, hopefully double digits. However, for me, the minimum is around 4%, which is what the inflation rate has been in the US for the last 30 years on average. Bit of a shame, the latest increase was in February 22, and well, it wasn't really an increase, was it? So 0%. So again, a red flag for me. However, you could say that it's compensated by that large dividend yield of 14%. However, is that yield realistically something that is going to be continue to be paid by the company, as that is a very important factor. We do not want to be buying companies where they will have a dividend cut. So if we take a look here, normally I would say this is positive. The yield is sitting around 14%, significantly higher than the 5-year average of 5.7%. The forward price to AFFO ratio is significantly under 6.7 to 14.5 year average, and the comparison to the industry is sitting at around half, 6.7 compared to 13.6. One thing I like to see is when a company is trending towards the 52-week low. However, we always have to investigate why this is, as it may not just be that it's related to the company being undervalued. So far I want to dig in deeper. So one thing I like to see around the adjusted FFO payout ratio is around 90% for REITs. So REITs need to pay a certain percentage to its shareholders. So here we have, if we can see over the last 10 years, this is sitting around 75 to 92%. So not too bad, nothing could cause major concern just looking at this in isolation. And if we look here, we were looking at the free cash flow payout ratio. Again, on average is around that 90%, with the last 12 months being 94%. Again, based solely looking at this, nothing to worry. So let's dig deeper. So the sales growth, as we can see in the last 10 years, there's that double-digit growth which has continued until 2019. 2020 was 46%. So overall, it looks like their sales has been increasing. So this looks fairly positive. And if we look at the actual sales itself rather than the percentage, from 2013 to 2022, there has been significant growth. So this is a positive. Now, continue moving on. One thing with REITs you will typically tend to see is where the shares outstanding increases, and therefore as a shareholder your position will be diluted. This is normally in order for the company to fund their property acquisitions, as they are unable to retain a lot of cash through their general cash flow, as they pay significant amount of dividends, as we saw earlier, around 90 to 95%. Now, moving on to the return on invested capital, I like to see around 10%. So this here we can see over the last 10 years has been between 4 to 7%. So not a positive, not a massive negative in my opinion, but let's continue. Operating margin on the left I think is more important for a REIT, as on the right when we look at the free cash flow, this can be distorted due to issues such as upfront rent payments, maintenance and deferred financing costs, which I'm sure most of you will be aware if you are homeowners. Now the operating margin, I like to see above 60%, and we can see here around 60 to 72%, so that's a positive. Again, nothing at the moment that's a massive red flag, but let's continue. So for medical REITs, we like to see below 6 for the net debt to EBITDA, earnings before interest, tax, depreciation and amortization. However, we can see that it's rarely been below that 6, which is a slight concern, as this means if we look at the next 12 months, it would take 7.86 years for the company to pay all of its debt. So therefore, this does give rise to a possible dividend cut, which isn't what you would want as an investor. Now, obviously, it's a lot of speculation. We also don't know what the dividend would be cut to, as it's 14% right now, and it could go down to even half 7%. A lot of investors would still be happy with that. However, that could then cause the share to drop in price, and relative to what you bought it at, the dividend may not make that up. So it's all really relative so far. Again, I've nothing positive for me to really want to jump on this right now. However, we are about to jump into the stock valuation. Now, net debt to capital, as we can see here, the last 12 months, around 54% of their financing has been from debt as opposed to equity. Again, around 0.5 preference for medical building REITs. So not too bad, not too far off. Now, one thing I would say is when we go on to our stock valuation, even if there is a risk of the dividend to be cut, if we can buy this at a margin of safety that we feel appropriate, it could be a buy, taking into the account that the dividend may be cut and this may drop the share price. Again, this is all speculation. So into Graham's valuation, if you've read The Intelligent Investor, you'll know this is Warren Buffett's one of his favorite formulas. Essentially earnings per share times 7, which is the P of a company with no growth, plus 1 times the growth rate projected, times 4.4, which is the average yield of a AAA corporate bond, divided by the current yield of a AAA corporate bond. So we put in our earnings per share. We've gone for a growth rate projection of 0. So I've put that in. That's based on analysts who have essentially forecasted a negative 1% growth. So I've been slightly on the more optimistic side of putting 0 as opposed to -1 negative. So this brings us to $7.83, and as we can see, this is lower than the current trading price. Now, moving on to the multiples, effectively what we're doing here is putting in similar companies in similar industries, getting to our average price to AFFO, and then multiplying that by the earnings per share. So let me update that for MPW, and effectively we get an average of 11.61, and this brings our stock price to 12.53. So that's higher than the current price. So I like to use a few different methods so that we can get a holistic view rather than just specifically pinpointing one method. Now, moving on to the dividend discount model, the formula is the price equal to the dividend for next year, which is essentially the current dividend times by our projected growth rate over the cost of capital equity minus the growth rate. Now, as we can see here, the average growth rate over the last 5 years has been around 3%. I've been a lot more conservative, especially since there hasn't been an increase in that dividend over the past couple of years. 1% gives us a DDM price of 14.65, again higher than the current trading price of MPW. So these are all positive signs of undervaluation. We move on to our final model, the discounted cash flow model, and we input our free cash flows. We get to our average growth rate. We then get to our future free cash flows, and we want essentially the present value of these future free cash flows and terminal value. And we add our cash, subtract the debt, get to our equity value, and divide by the shares outstanding. Now, as you can see, there have been a lot of fluctuations over the last 10 years for MPW. I've essentially, again, been on the more optimistic side with a growth rate of 1. A lot of analysts have suggested there could be negative growth within the company. Now, this essentially gives us to a DCF price which is significantly higher of $50. So I would personally say this is a bit more on the optimistic side. However, what we want to do here is come to the average of these 4 models, and we get to an intrinsic value of $21.27. Again, as you can see, within the 52-week range, MPW has traded around $21 within the last year. Now, what we want to effectively do here is find out what would be our margin of safety and what would be our acceptable buy price. Normally, I would like a 10%, which would give a buy price of $19. However, given the risk in the business, I personally would be looking at a much larger margin of safety, and I would personally saying at least 50%. Now, this would give an acceptable buy price of $10.63. So, in my opinion, if you are more of a risk, if you wanted more risk, as an investor, this could potentially be a stock that you would want to buy. Now, as mentioned, this is very risky given the risk that it has with the increasing debt, the decreasing cash. And one piece of news I'm not sure if you're aware of, however, MPW, one of their tenants, one of their biggest tenants, does have a possibility that they may not pay their rent. So a lot of factors, I can go into that detail in next video. But if we quickly look at Wall Street, they're forecasting a price of $12.50. So approximately 50% upside. Do let me know in the comments whether or not this is something that you hold, whether you're looking to buy or whether you're looking to sell. Again, this is not financial advice, and please let me know if there are any other companies you would like me to analyze. As always, have a brilliant day.